the bets were more in favor of September, but then you had China and all those other sort of dynamics that destabilized the financial markets. And so on balance, a lot of people are pushing for December and hoping that the U.S. will be a bit more sensitive in their move, in their exchange, in their decision to dynamics outside the U.S., which I think is what happened. We are not islands to ourselves, and I think it was clear right from the beginning. And the U.S., as we know, most of the dynamics in the exchange rate market have really been not just to ourselves, all emerging markets and the frontier economies has really been due to the action or expectations of action in the U.S. So that's why the dollar was strengthening, as we know. And I know I have journalists have picked up on this, and in the packages that you'll be given, there will be some charts that show that quite clearly, that it isn't just the Kenya shilling that was under pressure. All the currencies, or most of the currencies were under pressure because of the strengthening of the US dollar. Our concern is that there should not be instability in the financial markets. That's really the concern. And it will hit us if there's a lot of dynamics out there, if there's a lot of instabilities. Are we ready for it? In as much as we can. And I think we went through our own sort of test of that in June, July. So I think in that sense we have learned, we've learned the lessons. We've learned how to use those levers, the policies that are with us. So we are quite confident that we will approach it now. If in the end we have a tsunami or a nuclear sort of explosion, then everybody will be affected negatively. But I think the idea here is that the U.S. authorities will be much more prudent. And I think that's one of the points which I would say that we will be making that point when in the meeting that we're going to be having in Lima in the context of the in the context of the IMF World Bank annual meetings in 2 weeks. September 18, which is just last week, we had 6,180 reserves equivalent to that, US dollars. And also we have, as you know, so those are the reserves that we have today. Just under 4 months of import cover, which we think is sufficient for the shocks that are coming, that may come. At the same time, we do have access to the resources that are available to us now that the first review of the IMF arrangement have been concluded. And this is something in the order of 610 million US dollars, more or less. And we can access this, like this, meaning very quickly, in a matter of days if we needed it. It's there, it's precautionary, it's sort of our insurance policy. You don't want to be too quick with the insurance, but in a case of shocks, we can access it. So we have ample reserves to protect us against foreseeable short-term shocks.